Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Shares of Verizon continue to struggle, and investors looking at any investment like this should be able to make the bull case and the bear case for their investment. In this video, I'm looking at the bear case for Verizon. I did the bull case in another video that I'll link to right here, but with the bear case, I think there's a lot to be said about the company's debt and potential risks long term. So that's what I'm going to dig into here today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And let's start by looking at Verizon's balance sheet. These are the financial statements for Verizon. You can see $32.9 billion in revenue over the past 3 months. So very big business, very profitable business, $5 billion in net income over the past year. A lot of that money is going to pay dividends. So keep that in mind as an investor. But what I want to focus on in this video is really the risk side. And that comes down to the company's balance sheet. You can see that cash, only about $2.2 billion in cash. Now, there's a lot of money moving through the system for Verizon. People are paying their bills every single day. So there's money coming in the door. There's money going out the door, paying Verizon's bills. $23.7 billion in receivables. That's the bills that it's billing to customers. And then if we go down to payables, you got about $19.3 billion. So a lot of money flowing through the system, not a company that keeps a lot of cash on the balance sheet. What Verizon does have is a lot of property, plant, and equipment. That's $310.5 billion of property, plant, and equipment, less depreciation, which was $200 billion. There's about $107 billion of net property, plant, and equipment on the balance sheet. So this is land, wireless equipment, all kinds of other assets that Verizon has to operate the business. The spectrum actually falls under a different category. This is $150.5 billion in wireless licenses. That is the money that Verizon has paid the government to have the spectrum that it has to operate the business. So this is a ton of fixed assets that go into operating Verizon's business. And over the last couple of years, the company has spent close to $100 billion both buying spectrum and building out the 5G network that we see today that continues to expand year after year. To pay for that, Verizon takes out a lot of debt. Long-term debt, $140.8 billion. This is really the big risk number for Verizon. $140.8 billion in debt. That's not even including $12.1 billion in debt that's maturing within the next year. So all told, over $150 billion worth of debt to buy spectrum and build out the assets that are the operating business for Verizon. There are a couple of reasons those are concerning. One, Verizon's not making enough money to start to pay down that debt in any meaningful way. You can see that debt has actually increased over the past year. Not a lot, but slightly. That's because Verizon has put a priority on paying out most of its cash flow in the form of a dividend. It could be using that cash to pay off debt or buy back stock. I think actually both of those use cases would be better than paying out the dividends like it's doing today. But companies that pay dividends and have been doing so for a very long time don't like to change that trajectory. So this is definitely a concern. And it's a bigger concern now than it was a year ago because interest rates are significantly higher. Any debt that has to be refinanced, which this $12.1 billion will need to be refinanced because, like we talked about earlier, there's not enough cash on the balance sheet to pay that off. That's going to be refinanced at a higher rate than Verizon likely had from previous years. Interest rates were close to zero. So now we're going to start to see those interest costs go up. If we go up here to the income statement, you can see that interest expense, $1.2 billion in the most recent quarter, was up 54% from a year ago. That number is going to continue to rise because of the sheer scale of Verizon's debt and the increased interest rates that we're going to start to see impacting the company's income statement. The other concern that investors should have is there's simply not a lot of pricing power for Verizon. Verizon isn't able to price their product much higher than some of their other competitors, especially now that there's been a lot of consolidation in the industry. And essentially all of the three major players, Verizon, AT&T, and T-Mobile, have large nationwide networks. So there's not a lot of price difference between any of them. And that means that none of them are able to raise prices and generate an excess margin. Verizon's maybe in a slightly better position than both of its competitors from a pricing standpoint and from a margin standpoint, but it's not a lot better. And given the fact that it's paying so much in a dividend and interest rates are going up, we're going to have to see prices go up in the future to try to increase that gross margin, increase that cash flow coming into the business. If you're making a bear case for Verizon, it's that there's so much debt and there's so little opportunity to increase cash flow that the company's eventually going to get to a breaking point. And it's going to have to do something like lower its dividend payout or stop reinvesting in the business, which wouldn't be a good sign long term either. So that's really, I think, the bear case is that the price to earnings multiple, which is under 7, and the dividend yield, which is over 7%, are both just unsustainable at this point. And I think there's a good case to be made there. This is a stock that I own, so I lean towards the bears. So I lean towards the bullish side for this company, but there's definitely a bear case to be made. What do you think? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.